Hello, everyone. Thanks for taking the time to come here. It might be an early morning for a lot of you, flew in late last night, or maybe hungover from the activities of last night. So I'll open the panel with an introduction of each of the panelists, starting with myself. I'm Nishant Sharma. I am founder of BlocksBridge Consulting. We are a communication strategy consulting firm for institutions in the Bitcoin mining space. We also operate the Miner Mag, which is the premium research and news outlet for the mining industry.
Hey, I'm Andrew Bond. I'm the Chief Strategy Officer at Arkon Energy, Bitcoin miner and data center provider for HPC. I spent a lot of time on the sell side with these guys as well. So, yep.
It's Steve Weiner from Cohen and Company Capital Markets. I lead our M&A practice across all of our industry efforts, but recently have been spending a majority of my time focusing on Bitcoin mining. For those of you that may not be familiar with Cohen, we are an elite boutique investment bank founded in 2021 with a full-service capital markets arm as well as an M&A advisory practice, and we've had a dedicated group to the mining space since 2021.
Thanks, Steve. Kevin Dede. Does this work? Maybe there's a power button.
Power button, of course. That better? Yeah. Hello? Anybody there? Kevin Dede. I'm research analyst at HC Wainwright. I was the first person to write a investment research report for institutional investors on blockchain and picked up coverage of Riot blockchain at the time. It's now Riot Platforms. And my firm actually opened the gates for institutional investment and funding for miners. In the early days, investors didn't really want, and especially banks, right? Especially banks didn't want to touch or be affiliated with crypto at all. And it was, right, there weren't clear regulations around it. It was sort of thrown in this cannabis bucket. And my banker actually struck a deal with, I think, a clearinghouse in South Korea to get Riot funded, and that was late 2019, and that sort of opened the floodgates. So you have my banker and Steve to thank for the growth of this business.
Thanks, Kevin. Thanks for that introduction, guys. So, talking about banks not taking the industry seriously back then. Of course, we've come a long way from then. What are the main points that you guys look at when valuing a company or a deal that comes to your table? Would love to hear from all of you.
Sure, happy to start that one as kind of the banker on the table. And I guess I'll caveat that by saying I think I had a full semester course on how to value a company in business school, so I'll try to do it in about 1 minute here. Look, valuation's an art more than a science, and but at its core, the value of a company needs to be the present value of its future cash flows. Hard stop. So what we'll do is we'll work with our clients to build a really detailed set of projections based on all the underlying key drivers relevant to the space. So hash rate, hash price, efficiency, capacity, cost of power, et cetera, to arrive at a set of projections down to cash flow and use that to start the range of values, right? We'll also look at a multiples-based approach, and we'll look across the full peer set and really dig in on scale. So again, hash rate, capacity. We'll dig in on growth, profitability, and all the underlying drivers of profitability, so cost of power, OpEx, et cetera. And we'll look at leverage. We'll look at differences in business model, whether that's hosting versus prop mining mix, duration of power contracts, and ultimately take a step back and look at across all those key metrics, all the key comps, and try to form a view on where our client or the target should fit in there. Look, there's never a perfect comp, and that's where the art of it comes in. Ultimately or ideally, those two approaches, what I'll call the multiples-based approach and the cash flow-based approach, ideally those approximate each other pretty closely. They don't always, right? And the challenge with multiples, especially partly in this industry, is you have one set of multiples for the large-scaled public miners. You have another set of multiples for, call it, the smaller subscaled miners.
What kind of multiples? How are they different for both?
Look, I was looking at this a week ago, and obviously it changes all the time. But I think on a hash rate basis, the large-scaled are trading at $160 million per exahash online. The smaller-scaled guys are in the 30 to 60, 70 range. Right, so significantly different.
Yeah, so I agree with what he said. I think in this industry we get so caught up in these KPIs, and I think a lot of that has to do with the investor base right now is still very retail driven versus institutionally driven. So we need these KPIs that I would argue are somewhat meaningless to a certain extent, like EV to hash rate or something like that. Now, who really cares what your hash rate is, because at the end of the day, you're going to have to maintain that hash rate, you're going to have to spend another $100 million in CapEx to buy new miners every 2 years. So, the real thing I want to look at when looking at a business is what's your profitability, right? This is a commodity business. You look at any other commodity-based business, and we're looking at what's your profitability. Over the next month, we're going to have a bunch of the largest miners report their earnings, and they're going to be the ones with the largest hash rate, on the street, and they're going to have capacity to build out to 1,000 gigawatts of energy, but they're going to be wildly unprofitable. So, this is a scale business, but at the end of the day, when I'm looking at a company, I want to know if this company is profitable and if they can grow profitably. And I think that's something that as we get more institutional investors in this space, that's going to be, going to grow of more importance. And we're going to need to see real operational excellence out of miners and data center plays.
I'm going to borrow a couple of words from Fred Thiel because I think he's got a laser sharp focus on this and a wise sort of distillation of the variables. But if you want to sort of size up this business, because it's so capital intensive, it's about capacity, compute, and capital. And they're spot on, right? It's about having that access to capital to be able to fund that growth, keep pace with the growth of the network. But there's so many other nuances that when you look at a company that might be in play, it's not right to Andrew's point about what they're doing now. It's about how they're going to be able to keep pace with that, whether or not you're going to be able to help them keep pace with that. And it boils down to, honestly, I think it really boils down to access to power. And not just having a substation, but having an interconnect where you can have a say over how that power can be distributed. And I think you're going to see that play out more and more and more as the industry progresses, given the balance between HPC and Bitcoin mining. Other aspects of a deal are also critically important and boil down to the characteristics of each particular site, whether or not it has access to fiber, whether or not there might be two power sources, and whether or not there's access to water. Because as concentration of compute increases and density increases, air cooling is not going to work as well. So having access to water is going to be a necessary aspect.
Thanks, guys. So to summarize, you're looking at not only the current cash flow, but also future capacity and ability to keep up with the operations. And I was wondering if you already know what to look at, why are there so many, or there are some deals that we hear of which went south, as in there are lenders who lent money to miners who later had to declare bankruptcy. So in these cases, what seeps through the cracks? What is overlooked? What are the metrics that if were focused on more or paid more attention to, these things wouldn't have happened?
So Nishant, it's Bitcoin mining, right? And everybody's subject to hash price. We can't tell where the network's going to be or where Bitcoin price is going to be. and that makes it really difficult in the financial markets. And I'm sure Steve will agree that it's more and more difficult for miners to find debt. The banks just, it's not hard to, it's not easy to do at this point. It's pretty much equity. I think that's pretty much it.
Completely agree with that. I think the debt markets are essentially non-existent for miners right now. The equity markets are what's available, and really it's the large public miners that have their ATMs on the shelf and can access equity on an as-needed basis, and that's a real advantage in the space.
Yeah, I think that's one of the big differences we're seeing now versus the last cycle is just the usage. Again, I'll mention the retail investor base, right? Institutional investors have been slow to come in because of these ATMs and the dilution. We have the largest miners, I think, have already done over $1 billion on their ATMs this year, which credit to them. If they can dump those shares on the market and maintain their share price, that's a big win. And typically in industries where you don't have this retail liquidity, so think about the market, right? These miners, their trading volume is 40% to 50% retail. A typical industry you see closer to 10 to 15%. So it just soaks up this liquidity. And typically when a company starts doing poorly or is not making a profit, they have to look for a buyer, or they shut down. In this industry, all you find a nice bank like Wainwright or Cohen, you get the ATM going, and you're good to go. So I think as more institutions come in, that'll change. And a lot of the largest miners have kind of already cash strapped up, so to speak. I think as we move into more of this focus on hash rate and how much capacity you can get up, and how many miners you can buy versus owning an interconnect, having real access to energy, it'll change, and the debt markets will open up to miners that have real capacity to do things other than Bitcoin mining as well, like HPC and AI. And there's some that do, and then there's some that don't.
Spot on, Andrew. I think when you're talking about evaluating a deal, right? Steve alluded to this, but it's not just straight analysis of financials, right? It's also a look at the business model, right? An HPC company can attract debt. We've seen that multiple times at Applied Digital and CoreWeave. So there's an opportunity to access different parts of the capital markets. And that's, again, a function of business model, where a straight Bitcoin miner is a little bit more limited.
And Kevin, you touched on the hash price, and that is a very interesting piece of the mining puzzle when you're analyzing a mining company or even evaluating a mining company. I'm sure the audience would love to hear what are the nuances or what makes Bitcoin mining valuations different from traditional industries. A lot of these industries you guys already cover, so would love to know what are the differences you see from traditional industries or even new industries, but different industries from mining.
Well, I think in traditional industries, they don't have to use darts so much, Nishant. So, we set up a dartboard, we put a couple of Bitcoin prices out there and some hash rates, and we just throw some darts. No, it's incredibly difficult. So you want to look at scenario analysis, right, with sort of a baseline case, which is what I normally do, just a gently escalating Bitcoin price and a gently escalating network hash rate, right, to come up with a hash price that is usually a little bit lower than whatever we have currently. And that's because you keep seeing new equipment come in, and operators can run new equipment, which has a much better efficiency at a lower hash price and still make money. So that's what we use sort of as our underlying foundation. But I think to go through all the analysis that Steve and his team would do, they'd want to look at different scenarios, right? Maybe a higher Bitcoin price and a little lower network hash to give you the bullish case, and then maybe a bearish case. And I've seen some people take that hash price down to 3.5 cents. I think we're a little over 5 cents now, but anyway, that's sort of the general thinking that I use.
Steve or Andrew, you have any thoughts to share on how this industry becomes different in this context?
Yeah, I mean, I'll try to take the question from a different perspective, given the M&A topic, and how this space, from an M&A perspective, has differed from some of the other spaces I cover. And look, since I've been covering the space, which admittedly has not been a tremendously long time, what I would say is there has been a ton of M&A interest or M&A dialogue, but it's been difficult to get transactions across the finish line. And I think there's a couple reasons for that. First, I think we had the halving, right? And I don't think anybody wanted to do anything before the halving because there was just too much uncertainty out there. Then I think there's, unique to this industry, to some extent, there has been a real disconnect between what I'd call the public market valuations and the M&A values that we've seen in the space. And what I mean by that is, until very recently, there haven't been a ton of deals. The deals that have been done were at lower values because they were either distressed assets or they were one-off sites. They didn't hire an advisor, and they left money on the table. I realized deals done, sold to Marathon or whichever minor, and congratulations. But I think there was money left on the table in those transactions, and you add that to the volatility in the space, and unlike other industries, you can't just slap a 30% premium on the current share price of the target and expect that to be a legitimate offer.
Has this changed from the past? Was it any different a few years ago?
Hard for me to comment on a few years ago, but I don't think there was a lot of M&A in the space a few years ago. I think everybody was still going out there and building sites, which I think is, the other thing that's unique to this space, but starting to change, is that the buy versus build decision has been significantly tilted towards build. A lot of what we've seen in the processes that we've been running is, or hearing I should say, is, look, I really like the asset, but I think I could go build something similar or put up a new site for $500,000 a megawatt. So why, how are they going to pay for something where companies are trading in the millions per megawatt? That just doesn't work, right? I think what we're starting to see very recently is that's starting to change. I think buyers are waking up to the idea, especially following like the CoreWeave, CoreSci transaction and the report that Morgan Stanley and Goldman put out. They're waking up to the idea that, access to cheap, stable power is not as available as it used to be. So it's not as easy to put up a site. And you're seeing that in the purchase prices that were paid, by CleanSpark for Grid, sorry, thank you, and Riot for block mining. And I think that's going to start opening up more M&A in the space. And lastly, look, it's still a relatively young industry, and there's not necessarily an established ecosystem. And the people running the space are very, very smart people who have managed very, very difficult situations, right? But that doesn't necessarily mean that there's been a lot of deal expertise. And what that means is traditional lenses of how to analyze and look at M&A transactions don't always resonate. And there's just been, from my perspective, or seat, I should say, there's just been a higher degree of M&A education required.
Are there any anecdotes you could share without sharing information of the clients, of course?
Look, I think if I asked my team, they'd probably have 1,000 anecdotes. But look, I think it's just the traditional way of looking at M&A transactions is value creation, accretion dilution, and answering the questions of, is this a good deal for my company? And is this deal going to create value for my shareholders? And I think the answer to that is, if the answer to those questions is yes, that's a deal that should at least be evaluated, considered. But I think the question that at least historically, acquirers have been asking themselves is, instead of is this a good deal or is this going to create value, it's why should I pay more than what the last party paid for that transaction? or like I don't want egg on my face to be the first person out. But I think you're starting to see that change as power becomes harder to come by.
Yeah, I agree with a lot of the points there, and he was very kind to say, these management teams are great management teams, but again, like it's a young industry. It's the largest Bitcoin miners have been around like 5 years now, so you have kind of younger and experienced management teams. You have a lot of corporate boards that some issues there, like Bitfarms and Riot, obviously. So corporate governance is the word I'm looking for. Obviously, some issues in the space there, and so I think there's really three things that differentiate the space from other spaces, and that would be one. The second, as I mentioned a couple of times, is the retail liquidity, and third, like there's just not, if we're looking at a pure Bitcoin miner acquisition, there just really are not the same synergies as you get from another, similar space or commodity space, right? Like what are you acquiring? And I think that's changing, and changing for the better, right? Because we're looking at these businesses as energy infrastructure companies. And if you have the interconnect, and if you have real infrastructure and are vertically integrated, like that's worth a lot. But if you're just acquiring, a bunch of J21s or a bunch of mining rigs, like what's that worth, right? There, you got to buy a whole nother set in 2 years and another 2 years. In terms of acquisitions, right, you're not really acquiring anything. So you want to acquire energy infrastructure versus, you want to be long the infrastructure and short the rigs.
Andrew, I really like the way you phrased it last week, vanity boards. So that's definitely an arm wrestling match in a lot of cases. But yeah, this panel's got it absolutely right. It is about access to power. I think I'd add, though, there is some power in scale. And I think there's power in geographic diversity. And I think that provides investors a lot more comfort. And I think that's part of the issue that some of these smaller companies face on a day-to-day basis. And I know you're very familiar with that. And I think that makes the bigger companies get bigger more easily. And I think investors gain in that process.
I think that's right, Kevin, and I think that's why we are starting to see more M&A happen in this space. I think it's the power of scale. Look, I think there's been a lot of statements made over the last year of where they're going to be, of where miners are going to be at the end of 2024, or the end of 2025, and as power is becoming harder to come by, the ability to go meet those demands organically is becoming more challenging. I think geographic diversity is another one. I think that's why we're starting to see some of the M&A that was announced, this week. And then it's just, all about power.
And it's the same we are seeing because we provide public relations to companies in the mining industry, and we are seeing the narratives are changing too. There was a time when asset-light business model was a narrative companies would throw around, and that worked. But now that doesn't work. All the companies who use that narrative are transitioning to a heavier asset model now. And I think that is a testament to what you guys just mentioned. And I wonder if AI HPC has a role to play here. Is it causing this move where there is more focus on capacity or infrastructure versus asset-light model, for example?
There's no doubt that overarching pressure is creating companies to move, right? And I think it was really the substantive combination of CoreWeave and Core Scientific that really shook the industry to the core. There's been lots of chatter of HPC. In fact, Hut 8 bought a company, I want to say almost 2 years ago, called TerraGo. It had 5 HPC data centers. But it didn't really change the way that people were looking at the company. The CoreWeave thing was instrumental. And there is a lot of thinking that power is going to be impossible to come by. But not every site is going to be able to support HPC. You're going to need water. You're going to need fiber. You're going to need... Actually, you're going to want to be close to a city. Is it a Tier 1 city or a Tier 3 city? All those things are going to factor into the decision. But you also have to take a step back and look at power generation, right? There's plenty of power. The problem is that it can't necessarily get to the places that it needs to be and consumed. And a classic case of that is the state of Texas, where there's a ton of power generation in the west, but most of the consumption's in the east. So because of that dislocation, there's a huge opportunity for Bitcoin miners to continue to grow. It's just a matter of making sure that they have that power agreement and that they're flexible.
Yeah, 100%. The HPC and then really the CoreWeave deal changed the game. Like over the past, we were talking backstage over the past few weeks, talked to more real institutional investors that want to get involved in the space than any time over the past 2 years, really. So, with that, you bring in real investors, you bring in, more pressure on management teams, on boards to make decisions that are profitable for shareholders. And, that's how these businesses change, and that's how you start to see M&A, and you start to see, real change in this business.
Steve, we are closing soon. So with your comments, would you also like to comment on where you see the industry headed, given what we just discussed with the AI HPC pressure and the changing trends?
Honestly, I'd rather hear these guys' thoughts on it. I think they'll have a better view than I would on this.
Let's give it to the analyst.
Okay. Well, I'm still trying to justify that title, but thanks, gentlemen. Listen, I've been watching it pretty closely for the past 6 years, and initially it was just about trying to scale up. I mean, people were buying things. I remember when Riot chased down Whinstone. I thought that was an incredibly bold and fabulous move for them because they had a site in Oklahoma that was very difficult to operate. They relocated miners and were hosting in northern New York State, and now they're on a rampage, right? That block deal, chasing down bit farms, and I think that's what we're going to see more and more of, right? Because they've got the retail following, as Andrew's mentioned. They're recognized in social media, and the stock carries a lot of weight.
We got to wrap up. I know this is an interesting topic. You can meet the panelists behind the stage and continue these conversations. Thanks a lot for taking the time, gentlemen.
Thank you, Nishant. Thanks, everybody. Happy to be here.
Next year, we are bringing the Bitcoin conference to the American West, Las Vegas. The brightest minds in the world will converge to deliver Bitcoin history. Buy your tickets now at b.tc/conference/2025.